Economists see markets as a way of funneling savings into corporate investment, or perhaps as a way to harness the wisdom of crowds for valuation, or as a way to make long-term investments liquid and easy to trade. But explaining moves in the market is much closer to storytelling than it is to economics, with the story constantly being rewritten by investors. The past few months have seen the story evolve more rapidly than usual. Now a new plotline seems to be developing. Back in August, many investors were unwilling to read on, fearing the worst. Our dumb but lovable hero, the S&P 500, finally realised that it was wrong to think that the Chinese leadership were infallible. As the impact of the renminbi's devaluation was debated, I've rebased this chart here to the day of the devaluation in August, the story then changed to suggest not only that the communists were human after all, but that they were particularly incompetent at handling the economy and the markets, and they'd allowed the Chinese dragon to be slain by bears. You can see markets as a whole. We've got the S&P 500 here in red, FTSE 100 in blue, Eurozone stocks in yellow, and the emerging market shares in green. All of them came down very sharply, had a bit of a bounce and came back down again as people worried about China and the knock-on effects. But our hero's never down for long. After a bit of uncertainty, the S&P concluded that the dragon of China was merely injured, not dead, and that after all it would continue to gobble up natural resources such as copper and iron ore. Back on his horse, the hero raced off again towards the next earnings season. Now, along the way, the scribes in the market started to inject a new tale. The wizards in the world's central banks were preparing to tap their magic money trees again, so our hero would soon be happy ever after. Share prices, both the US and emerging markets, are now almost back to where they started. This is the 100 line before that Chinese devaluation. Although I should say that UK and Europe are further behind, even when measured in dollar terms, as on here. Now, while market stories each hold together in a rather quixotic way, they rarely turn smoothly on to the next chapter. So consider China. Its problems are a threat to the rest of the world because China might buy less stuff, particularly commodities, from the rest of the world, and they might sell more of their own excess stuff. Leading example at the moment is steel, to the rest of the world, so driving down prices and increasing the risk of deflation, as well as hurting foreign manufacturers. Now, this story hit the biggest suppliers to China, both the miners, I've got the shares of the miners here in red, and countries led by Brazil, which host the mines. And you can see the green line here shows the value of the Brazilian currency against the dollar. I've also put on here the spot price of industrial metals, that's the blue line, and that moved around a lot less. Warehouses full of aluminium ingots or copper cathodes are more sensitive to immediate supply and demand than to speculation about trouble ahead, which is what was driving the mining shares and the real. Now, what stands out is the recent pattern. Hopes for China faded somewhat after the rebound, so the last 3 weeks have seen a broad sort of stabilisation to decline, even as shares elsewhere continue to recover. If I go back to that previous chart, you can see we didn't see that downward trend repeated in broader markets. Now, the two stories can be reconciled. Money created by central banks in the developed world is expected to boost share prices, not commodity prices. This is, of course, a different story to the early days of quantitative easing, when the Federal Reserve's grand high wizard, Ben Bernanke, was widely blamed for a stream of cash flowing into commodities and emerging markets, pushing up prices. This time round, the story is that the Fed will keep rates on hold, along with the illusionists at the Bank of England, while the sorcerers at the European Central Bank and the Bank of Japan will conjure up more cash, all of that easing helping equities. China's harnessing the magic of the People's Bank to stabilise its own growth, but this is all the help that's coming to commodities, with the developed market central banks not really making much difference this time round. Now, this next chapter may last a little while, at least so long as the central bankers pull something more than a rabbit out of their hats over the next week. But investors should remember that markets never have fairy tale endings, and this one will soon morph into the next story.